Chapter 4, we go into detail on preparing an income statement, and we have the two, the multi-step and the single step. And then in part 2, what we're going to cover is earnings per share, statement of retained earnings, other comprehensive income, and what to do when we make a mistake. So first we're going to start with part 1, chapter 4. Again, this is Intermediate Accounting by Kisu, the 16th edition. First, you need to understand what are the elements of the income statement. We have revenues, which are inflows that increase assets on our part of the primary business. We have expenses. These are assets consumed generating the revenue that is primary to the business. Gains or losses increase or decrease in net assets that are incidental to the business. An example of this would be if we bought somebody else's stock or bonds and sold them and made a profit or had a loss. Also, if we were to sell some of our equipment, these would all be part of gains or losses, along with interest income or interest revenue or interest expense, or if we receive any dividends based on owning another company's stock. A new area we have, which is actually just part of gains or losses, is what if we have something that is unusual and infrequent. We used to call this an extraordinary item, and it was shown after tax. However, because of the convergence between GAAP and the international standard, we now have gotten rid of the category called extraordinary items, and now instead we put these all as part of gains or losses. All of these items above are shown pre-tax. Once we show net income from continuing operations, which is net of tax, then we have a few items that will be shown net of tax. Discontinued operations is one. This is when we eliminate a business component, and this is always shown net of tax. And the minute we make the decision, we have to start isolating all the expenditures and revenues from that particular operation. Another category not shown here would be if we have a non-controlling interest. You will have a line item which you will subtract out called non-controlling interest if you buy more than 50% of another company's stock, but you own less than 100%. The rule is that you must do consolidated financials. You must roll in 100% of the subsidiary's income, expenses, assets, and liabilities into the parents. And the portion that you don't own, the percentage you don't own, you have to back out on the income statement. And you learn more about this if you take advanced accounting. So some things to think about when you're doing the multi-step income statement is you always list expenses based on how closely they relate to the generation of the core revenue for a business. You would show cost of goods sold, then selling, then administrative, and then other, in that order on the income statement for the multi-step. The income, the reason the multi-step is good because it tells investors, are you making money in the business you're in? And it is important that you know how a company is generating profits so you can figure out what might happen in the future, or predictive power. An example would be if you're looking at a company's income statement and you notice that a lot of their profit is being generated from selling off their assets, that's usually not a good sign. Now let's take a look at this example, and we're going to do this for preparing a multi-step, a single step, earnings per share, and the statement of retained earnings. So the first thing we're going to do is we're going to look at this and we're going to figure out what do we need to prepare a multi-step income statement. And we do this in parts, and what I like to do is check things off as I use them. So the first thing we want to figure out is what are our net sales. So what we would look for is what were our sales revenue, and then do we have any contra sales accounts such as sales discounts or sales returns and allowances. These are always treated as a reduction of sales and never shown as an expense. They are contra sales accounts. which means they must follow the account they're contra to. So we found our sales items, and now we can do net sales. We're going to take sales, we're going to subtract out sales discounts, sales returns and allowances, and those two accounts always have a debit balance because we know that sales has a credit balance. And now we come up with net sales, and again, you want to remember to subtract those out. Normally, when you look at anybody's financial statements, all you're going to see is net sales. They usually don't give you the detail on how much they had for discounts or returns and allowances. Okay, the next thing we need to determine is what is the gross profit. And to do this, we have to look for cost of goods sold. And there is our cost of goods sold. So now we can do our gross profit. So we're going to take our net sales and we're going to subtract our cost of goods sold, and there is our gross profit for our company. Now we're going to determine our selling expenses. So we're going to go through this list, and in some cases it tells us it's sales, and then others we have to make the assumption that they're sales because of the nature of the expenditure itself. So we would include salaries and wages because it says sales. We'd include sales commissions. We'd include travel expenses. Now, we would also include delivery expense because normally that's associated with the cost of selling the product. And entertainment usually has to do with entertaining people, so they buy the product. We have telephone, we have depreciation, we have maintenance, we have miscellaneous. And we also, when we go to the column on the right, we have bad debt expense. Now we can do the section called selling expense to get one number. So we'd add those all up, and in this case we would list them based on largest to smallest, and we get selling expenses of $248,785. Again, there's an assumption that delivery and entertainment expenses are part of sales. And again, if you looked at financial statements, in most cases, all they show is one line item for selling expense. Now we're going to determine administrative expenses, and we're going to go through and look to see where are admin expenses. So we start on the left, and office supplies used would be an expense, telephone expense, depreciation, property tax, maintenance, office expense, and that should be it. So now we can do our admin expenses. So again, we would list those highest to lowest, and we get one number for administrative expense. Now we can do income from operations. We would take and subtract the selling and administrative expenses to get total operating expenses, and now we've got income from operations. Now we're going to look for other. And again, this number tells you, is the business making money in its primary business? And it's always shown pre-tax. Now, do we have any other current year revenue or expenses that have to go on the income statement? Well, we would have to include dividends received because this is income to us. We have also interest expense, which is a cost of doing business, and we have our income tax expense. Now we can do net income from continuing operations. We're going to have a category called other revenue and expenses. We're going to plus our dividend revenue and subtract out our interest expense to get income before tax. Then we're going to subtract our income tax, and now we're going to get net income from continuing operations. Now, if we had any discontinued operations, any non-controlling interests, net income that we would back out because of non-controlling interest, or we had any other comprehensive income, we would show those as line items, net of tax. Again, everything below that number is going to be net of tax, and this becomes net income if you have no other transactions. This concludes Chapter 4, Part 1, Multi-Step Income Statement, and now we move to Part 2.